All right. How's that audio, Matthew? Starting 10 minutes early today, guys. 10 minutes early.
What'd you say?
Just chatting, just talking. 1:50 p.m. Central Time start. Scott Bauer. Brent Kochuba. Pete Najarian. Jay Soloff. Howard Chan. Ask anything. All right. Good afternoon. Welcome to Chicago Future of Finance. A couple minutes early here as we got a stacked show coming up before I take a little vacay. Now, markets are also trying to take a little vacation from the crude oil damage. Not bad. You know, we're looking okay here. Equity market has stabilized. VIX still pricing in way bigger moves than we're getting. Basically with VIX here in the mid to upper 20s and the market either grinding higher or just not going down or moving pretty quietly, leaves a lot of room for surprise to the upside, I think still. Yellow on the risk radar across the board, a lot of things still staying range bound, thinking about the potential for bond yields to break out obviously, but we're still kind of hugging that 4.3-ish area, so I'm just not in a panic state about that yet by any means. Dollar too, which has come back down after a pretty big push to 100. That seemed like a pretty clear line in the sand for the greenback. Look at the chart at the dollar there. Just bang, bang, right at 100, can't get through it. So I definitely think that a lot of things that could go wrong here haven't quite yet. Yesterday we talked about how the odds of a hike and a cut are like the same basically. The odds of a hike now basically a coin flip with a cut. That's a really weird spot to be in, to have those things even. So it's natural then for the market to have quite a bit of tension. But I think that's why there's a lot of yellows there, because we do have unresolved issues. Now, obviously, you probably think cuts are going to be better for the market. If we don't get them, maybe that's a problem. But I never really thought we needed the cuts to begin with. So I'm not too worried about the macro backdrop is essentially what I'm saying. Yesterday, we talked with Sam Rowe about Wall Street risks and what people are concerned about. I thought that was an illuminating discussion, because when you see the risks, the tail risks ranked by Wall Street strategists, you've got geopolitics as number one, and then you've got inflation number two, and then way down at the bottom of the list is tariffs, which is pretty amazing, because when you think about it, a year ago, that was a VIX 20 environment was tariff, or 60, sorry. That was a VIX 60 environment. Look at the big candle there on the left. That was tariffs. And in my book, tariffs basically are geopolitics. It's politics, it's trade, and it's geo, it's around the world. And that was a VIX 60. And obviously that was an incredible buying opportunity. The last days on the Schwab network, my exit monologue was basically pounding the table on buy, 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 because geopolitics are the number one buying opportunity. Now, however, inflation is a different story. Inflation can be a very ingrained, long-term, systemic issue. That was the 2022 bear market, because we had to hike our way out of the COVID inflation. That's a different story. So really, I think still the main issue here is if the geopolitics turns into an inflation story. Now, that certainly has higher odds of happening when crude oil is very elevated, and at $90, that's certainly a risk. But the fact that markets have been able to stabilize here with WTI as high as it is, I think continues to show some hope. Keep in mind, we've got earnings coming up pretty shortly, and the banks, which have been under some stress because of what's going on in the private markets, might not exactly deliver a big blowout quarter. But if the market can find general growth for earnings, which is what we expect, then you might have some good news coming on the back of that. If you zoom in on the short term, look at the Russell today. Don't want to get too carried away with this, but if you really, really zoom in, you do have higher highs on the Russell in the short term. The small caps at 25, 34. I mean, just on the absolute margin here, you are putting in a higher high for the Russell, and higher lows too. So there's some hope there. That's generally encouraging. If you look at the S&P 500, we're not doing that. The S&P 500 is still making lower highs. So that's why you've got to have at least a yellow light on the risk radar for stocks, I think. But you actually are getting now in the S&P since Monday morning some higher lows here. Again, this is really marginal stuff. And I don't want to get too technically bullish based on this, but there are some signs of stabilization here at best. And with VIX still as elevated as it is, I just think that the story is kind of shifting over to the need for increasingly negative things to keep volatility bid and the market under pressure. And that's an important regime shift from the normal situation, which is stocks are strong and you need bad news to push them down. I'm kind of thinking since stocks have been weak, we might need incrementally worse news to keep the VIX elevated. That's basically my spiel. I don't have a whole lot else to add. Yellow lights across the board. The only thing I would say is that the SMH still is, I think, the most important sector, and the fact that you now have range bound holding in for the semiconductors, and now SMH at $400. That's pretty much right in the middle of this. What do we got there? About an about a 40-point range. Sorry, $40 range between 380 and 420. So okay, right in the middle, 400. Hard for me to go up in arms in fear about all of this. Got a great show coming up, by the way. We got Scott Bauer joining me here early to get things started. We got Brent Kochuba right behind him to talk about some of the second derivative flows and what we're seeing there. Do a little assessment of last week's expiration fallout, as we did with Scott last night. Pete Najarian's joining me to talk about what he's been calling the Burl Ives trade. The metals are resurging today a little bit. Maybe that's the last chart I should hit real quick before we bring in Scotty. Gold up 3%. And silver getting a bid, but boy, it's been absolute carnage in metals for the last 5-6 days, maybe stretch it back possibly just this whole month. So I think you've got to be very careful in gold, and that's why I've got my yellow light there as well. Not a green as I had for a very long time in gold. That is, I think, an important distinction. We've got Scott Bauer on the line, Prosper Trading Academy, taking a break from the skis and doing interviews with his son. Scotty, what's going on, man?
Yeah, the interview yesterday with you, and then I had one with my son from Kingsview Wealth Management. So pretty good, pretty good day. And today, it's about 75. I decided to stay here and trade all day instead. So yesterday was the real background. This one's a virtual one.
Yeah, right. It's hard to tell the difference sometimes, but when you don't have the glasses on. Did you like my tweet yesterday? I said, I'm a single issue voter, and that issue is normalize doing hits from the mountain.
That should be the norm. No question about it. That should be the norm.
I'll give Jake a little plug here and pull up your guys' interview, How to Trade Volatility, Options Pro Strategy, featuring Pops. It's positively sloped. Jake's, I think, got a nice future in the podcasting and recording business. He's got a great voice, number one, and you guys were looking pretty good too, talking about some important stuff we discussed yesterday as well, which was options expiry, the kind of fallout from that. I got to say, Scott, VIX is looking very stubborn here, but in many ways I find that to be kind of full of opportunity.
Yeah, there's a lot that's looking stubborn. I agree on VIX. We're down a little bit today, 25 and change or so. We haven't really seen that break that 30 level, albeit, just for a few brief seconds a couple times here. But elevated VIX, when I say elevated, that is the new norm. Historically, we're used to seeing VIX in the mid-teens, even lower, sometimes down to the lower teens. And that range is now shifted. I think that range that we can see in the near future is probably 20 to 28 or so. 30 definitely is the outlier. I can't see a situation breaking below 20 unless there is a real ceasefire. None of the back and forth stuff that we have seen across the news wires, where one side says something 1 minute, and then literally within 30 seconds, because of the way the world works with social media and how quickly news flow travels, we see the opposite. So I can't see VIX breaking below 20 until that happens. Something you just talked about, though, Oliver, SMH, kind of staying right in the middle of that range and being kind of stubborn, if you will, like you said, in relation to the VIX, no question. And right here, right at 400, which is the middle of that range, that's also the 50-day moving average, which it's fighting to get above. It hasn't deviated far from it, below it, but it can't break through above. It'll be interesting to see if it can break above, if it then becomes support instead of resistance. And if we start to see that, we could maybe start seeing a shift for a lot of the semi stocks.
I love the 50-day edition. I just pulled that up on the chart here. Key level, that is kind of, if you want to do the gun to the head thing, which I don't love that analogy, but whatever. Then my gun to the head scenario is, if you have to force me to be bullish or bearish, buying or selling, stocks as a whole, risk as a category, my determining factor for that, my coin flip for that will be, is SMH trending up or trending down? And right now, on the margin, it's sideways, but we put in higher lows. And if we're above that 50 DMA, I have to call that uptrending still. So I think that's crucial.
I agree. And, you go back to the red lines you're drawing there in that range bound trade there, right? This is ideal, absolutely ideal for something that we have talked about that maybe people are sick of hearing already, is an iron condor type of trade where if you are really uncertain about direction, but you want to take advantage of really expensive premium, there you go. This is an ideal situation because you can collect a lot of premium and play that 380 down below, play that 420 up above here. Now, if it breaks through, it breaks through. It's always risk defined, but you're looking at that channel that is so well defined there, that might be an ideal consideration.
I'm totally with it on that. I totally agree on that. I just pulled up the volume profile too. Tons of it right at $400 on SMH, right? I mean, it's just screaming out, this is the level, this is the key area.
Absolutely. And those are some of the things that we look at. And again, with volatility levels the way they are, premium levels the way they are, boy, we're able to take in some hefty credits and really limit that risk if there is a blowout move one way or the other. And again, this is just the perfect type of setup if you are a little bit unsure of a move higher, lower, or as we have said, recently, you can do an iron condor and give it a little bit of a bias towards the upside or towards the downside. So, any of the listeners that are trading options that don't truly understand this type of strategy, this type of setup, dive into it a little bit, get some help, dive into it, and see how it can really perform well.
Yeah. We talked in this category, Micron, right?
Yeah.
Which is getting hit again today, but still staying above the recent lows. So I do think that kind of fits, even though this is skewed bearish now in the last couple of days of price action. Has it held the range you're looking for with that local low at 360?
So it's definitely on the lower end of the range, but it is still in the range. It is still in the range. So, I am looking for this to hold. It doesn't have to bounce back. Even though this is, tilted towards the bullish side, it doesn't have to go back up. It can just remain right here. It can even go down a little bit further, and we're going to get that premium erosion. The options I used for Micron were next week. So once we get through the weekend, if the stock is still somewhat in this range, 380-ish, even if it's a little bit lower, that's when a lot of the theta will kick in, especially with the short week next week. We got to remember, next week, we've got options expiration because of the holiday Friday. Options stop trading on Thursday. So it is a shortened week. So if anybody is putting any sort of positions on, looking to harvest some premium or wondering about what might happen to that theta, just keep in mind, Thursday's the last day next week.
Right. So then correct me if I'm wrong, that kind of puts extra onus on a move, or else vol's going to come in when you're missing a day.
Exactly right.
Yeah. All right. Obviously, so the general idea there, the way I remember it is, the logic is the more days there are, the more possibilities there are for things to create volatility. So if you got fewer days, lower chance of volatility. Fewer days in the sample set that the VIX is going to calculate, compared to normal. So.
And I know I'm an option geek, and I apologize for this, but you just hit the nail.
That's where we're at.
When we talk about volatility risk and Vega, which is the volatility component, that is why the further you go out in time, the Vega number or the Vega risk is higher for exactly the reason you just said. More time, more possibility that something could happen.
Yeah. VIX at 26 right now. This thing has really lifted off from that baseline. Scott, to your point, we need good news. But I wonder also, do people just get used to crude elevated, or do you think this market is going to stay pinned inverse to crude for the time being?
Definitely inverse, and the unfortunate part for the trading community is it's elevated because of the geopolitical risk. It's not elevated due to supply demand issues, at least not yet. It's all of what might be because of the geopolitical risk. So, that is going to still stay in this range. I still don't see us getting to the 130 that we talked about. And I'll stick by it and say once this is resolved, which we all hope is much sooner rather than later, I think we see a 6 handle on crude.
Okay. Hey, that was the long-term trend. It sure seems like a far ways away right now, but
yes,
guy can hope. By the way, the Cal sheet bets right now for U.S.-Iran ceasefire, you start to get about 50% around April 30th. So we could be in for a bit of a waiting game. Scotty, thanks for tuning in from the mountains.
Thanks a lot, Oliver.
Looking forward to being out there in about 7 hours, baby.
Oh, sweet.
All right, see you, Scott. Thanks a lot. Prosper Trading Academy. Scan the QR code, figure out the trading system from Scotty and team. Good stuff. Looking at the iron condors, particularly on the SMH. I think that chart is absolutely crucial right now with that ETF trying to hold and trying to hold right in the middle of the range. Let's talk about some options flows. Let's go to the world of Brent Kochuba at SpotGamma and maybe talk a little bit about that kind of shortened calendar we got ahead as well. Brent, good to see you. Welcome back into the hot seat.
Thanks, sir. How you doing?
Pretty good. How's you were on the opposite end. Scotty's in the snow in the mountains. You were down in the swamps and the Keys.
That's right. It was nice down there, I'll have to say. Springtime's starting to pop up here in the Northeast, so you see the tulips or whatever they are coming out of the ground. Things are starting to look up a little bit, so that's
there you go. What do you think of this market, Brent? Are things starting to look up a bit? I mean, we've stabilized. I'm really reaching for my Russell chart showing the marginally higher highs on the short term, but obviously there's still a lot of tension in this market.
Yeah, I think the big thing is that on Friday, Saturday, Sunday, we were all looking at Armageddon. I think if you read the founder's note that I put out Monday morning, it was right before the Trump tweet. It was sort of like get in your crash position, right? And I think we were starting to look quite crashy. Oil was breaking out over 100, and we were starting to see downside levels really open up, right? So looking at something like 6,000 the S&P was looking really pretty bad. Vol was starting to really kick in and pick up. Trump comes out and tweets, obviously a 5-day stay of execution, I guess, or whatever you want to call it. I don't know who's going to get executed, but put that back. And now today we're talking about possibility of 1 month peace talks. Now, Iran is saying no. I'm not a macro analyst. I don't know. I know that there's a whole bunch of back and forth here. But the key thing that I think we can take away from this is twofold. Number one, we're having conversations, or there's talks about talks at least, right? Before there was no one's negotiating. We're just going to start blowing each other up. And so the Armageddon scenario seems to have been taken off the table for now, thankfully. And the reason that matters is because I think we're now in more of a range-bound market as opposed to looking at this vol breaking out to the downside. And so when I look at the range of 64.75, people should not forget about that strike. That's the JP Morgan collar leg that expires on 3/31, so that's on Tuesday.
64.75, literally the touch low the other day.
That's exactly right. And that's going to be a shock absorber to the downside. So I heard Scotty there talking about iron condors, for example. And I think that leaning on that strike right now with this somewhat elevated vol premium can make some sense, leaning on that downside strike, because I don't think we meaningfully break that downside strike. In fact, I would bet on maybe possibly a pin into that level as kind of the worst case downside scenario into 331. Now that's a worst case with an asterisk because, as we all know in this environment, worst case is, a heck of a lot worse than a normal environment, right? And so I'm taking that nuclear, scenario off the table or whatever it may be. So that's the shock absorber in the 331. After 331, I don't really know. Now to the upside, it's interesting, right? As soon as we got the first sniff of a deal, market rallied 3% from the lows in about 5 minutes, right? Not even. That's like April 2025 level of upside volatility that we saw. Why? Because people smacked vol as fast as they could and puts started to get sold. People dumped their hedge protection, and then we find out that, it's not actually a deal, right? So what happens now, I think, is when we get rumors of upside, we get a 1% rally now, right? We kind of test the 6,600, 6,700 level, and then that kind of fades when it's like, well, Iran says they're not talking, and then they are talking, so it's back and forth. So I think that upside is going to remain capped until it's like pens have been signed, Iran says we're good, Trump says we're good, and then then we'll get a final vol crush. VIX probably goes back to 18 in that scenario, and then I think S&P's over 68, probably into 6,900 at that point. But until then, you have two red lines on your chart there, 6,800. I think that's probably a little bit too high. I know you're not drawing off of those levels, but I would think more like 6,700 as the upside for right now. And then to the downside, I'm just going to call it 6,500 because of that JP Morgan. And I think we're just swinging back and forth in there, at least through Tuesday. And if we get a deal, obviously, 6,900 is on the table. If things get much, much worse, then you got to look at, 6,300, I think, is the main low. Now, the barometer I said on my founder's note is I'm watching over $100 oil is the Armageddon scenario, right? Under 90 in oil and crude is what I'm using for I think we have a deal, and the market is starting to suggest that that we got a deal, and that's what I'm using for my geopolitical macro ignorant seat of saying, okay, time for equity risk on is oil gets under 90. Time for brace for impact is oil gets up over that 100 level. Funny, you can see that sort of range.
That's there. Encouraging because I kind of, again, no geopolitical expertise either. We're just when it comes to what matters.
Don't know. It's
yeah, the pain point for oil is a little bit kind of finger in the air. I was kind of thinking maybe like 80-ish, 85. I like that your triangulation puts you at a bit of a higher number. That suggests that we could be gaining some tolerance to elevated crude a bit, you think, now that we saw the 125 come and go?
Yeah, I think that's exactly right. It's over the weekend, right? It was like this escape velocity in oil prices, and maybe that's back on. And then, Miguel put out a note today from Namur is always so good. It's like basically everyone's just short rate balls, what it is. Because if oil goes up, then rates go up, then equities crash, and inflation, and blah blah blah, right? So everyone knows that narrative right now at the moment, and so I think a slow rate of change in oil or oil sub 100 is like we can all deal with that. At least here in the U.S., we could deal with that. It's not great, but it's not crashing, right? That can be contained. I think when you get over 100, then you start looking at convexity in oil prices, right? Because they're going to really possibly spike, and then you get vol convexity, and vol convexity is where things really smash. And if you start to get rates really moving, then the credit issues, which were just kind of percolating a little bit with the blue owls and the like, then those all become, I think, much more serious because rates get really jacked up, Like I think the 30-year mortgage is around 7 last I looked at it the last day, but that's the kind of like economic like carnage I think that picks up when you get convexity in the rate space, in the equity volatility space. And it sounds funny, you go, well, equity volatility doesn't have to deal with, with the macro so much. Most people's wealth is based on how the stock market's doing, and I think
increasingly more so too, with people, tied to it. So I totally respect.
And that's how the politicians, currently this administration weighs, their success, right? How
decision making on that.
Yeah. Yep. So, that stuff is all really tied together. And for right now, I think the idea that we have stepped back from Armageddon and we just kind of have this big swingy range, but it's 200-ish points. That's basically what we had, Oliver, from Thanksgiving up until June. Was the range was just 6,600 to 6,800 basically, right? Back and forth and back and forth.
Correct.
Now that
just
range
kind of pushed it down
a little bit lower. That's it. That seems to be it. Buoyed by the JP Morgan 6,500-ish position. Once that expires and once that clears out, that's not until Tuesday. Tuesday's a different world from where we are today. I'm sure there's going to be a lot of development, so we'll have to kind of reassess that. But for right now, I think the idea is the trades that seem to be working in my mind, Oliver, are I think condors here do make some sense. I also think owning stocks or owning spiders and selling calls against them is a decent enough strategy at the moment for that income, bringing in that income, because calls are trading pretty rich right now because people are worried about that quick right tail, right? Trump tweets something, market goes up 3%, and I think that vol's a little bit elevated for there. But here's another thing I pointed out. I put in this chart out on Twitter today and with our subscribers. Single stock vol is really cheap right now, particularly relative to index. You could buy Tesla, Nvidia, Apple, Palantir calls for very, very cheap right now. And I think owning a tranche of, 1 month to 2 month out Mag 7 type calls, you can maybe even sell spider calls against those to kind of offset some of that. I think that makes a ton of sense right here, just because those calls are so cheap. And so if you buy cheap calls and you're wrong, well, you lost on cheap calls, no big deal. And obviously, I think if Tesla, Nvidia, et cetera, they're going to move if the market really has a substantial rally from here. And so I'm starting to really warm up to getting long some calls in that space as a way to play a nice right tail move.
So we're kind of in that. So, Brent, just to come back on that point, that's important because it seemed like then when you were talking about owning equity selling calls, then you were talking about at the index level, and but not. So we're still getting some of that dispersion, but it's kind of flipped around a little bit here because wasn't the dispersion situation before index level was low vol, but the stocks were high vol. So if we kind of reverse that a bit here.
That's exactly right. And this is on a relative basis, right? And so if you look at like the IV rank of the spiders, for example, the IV rank of spiders is 35. Now that may not sound that high, but that's generally speaking for, kind of a risk-off environment. That's not a panic environment, but that's risk-off. You look at the IV rank, for example, of NVIDIA or Tesla, it's at like a 5. So that just tells you that on a relative basis, the IV of the single stocks are a lot cheaper, right? And it matters what stock you're looking at, but the MAGs are a great example. Those are a lot cheaper relative to, say, spiders. Now, what's funny about this is it seems to be the MAG 7 names, which also now have Monday, Wednesday, Friday expirations. I haven't fully linked those two things together, but I can't help but wonder if those single stocks and MAG 7s have some cheaper vol now because of this Monday, Wednesday, Friday expiration, and that risk can be managed a little bit differently. And still trying to piece that together. We've only got like about a month and a half of data on that, so I'm not chirping too much about that at the moment. But the point is the same. If you want upside exposure, you can get it for very cheap. And I would argue, based on what we saw, right, when Trump said, we got a deal for a second there on Monday morning, we ripped 3%, right? So I don't know that we would rip 3% in 5 minutes again, but the idea that we would very quickly gain, say, 2% to 3% over the course of, say, 3-4 days, when people buy in, or maybe even a little faster, people buy in, okay, this is a real deal, this is over. And then you can get some more trend in that upside. Having a 2 to 3% day, not necessarily 2 to 3% 5-minute candle, right? I think would be certainly on the table. And the way to play that, would I think be these very cheap single stock calls.
Love that perspective. Very interesting and an important shift. And to kind of generalize this, I pulled up that Core 1M, and obviously correlations have risen. So the index vol has risen with that. But it sounds like an interesting opportunity then, because if you've got some single stock views, maybe it's actually advantageous. I mean, I guess could you own, say, an NVIDIA call and then sell an S&P call with it, something like that?
Yeah.
That's kind of combining
exactly
everything
right.
you're saying, right?
Yeah, that's exactly right. And I think that's that's maybe the second level move if you don't believe in this. And obviously spiders would rally if the market rallies, spiders rally, and single stocks would rally with them. Like NVIDIA and Tesla, if they go up, well, spiders are probably going up too, right? So maybe that caps a little bit too much, but maybe you're sophisticated enough or able to sort of navigate that, or just want to offset and say, hey, I'm going to sell one spider call and buy 2 NVIDIA calls because I can figure out a way to make those premiums pay off, right? So those are the types of things that I think are on the table right now. But at the end of the day, so much of what trading is find what's rich and find what's cheap and find what no one's looking at. No one wants calls, right? That's why they're so cheap. And no one believes in a deal right now, I would argue. People have, for many valid reasons, sort of lost hope, I think, generally that anything good is going to come out of anything in the next couple of months. And so, or even days, right? And so I think that soft spot is the calls. Now, does that mean they pay off? No. But if we get a deal and the market rallies, then those are going to be wonderful trades. They're going to look really great. Puts are kind of expensive right now. You don't want to really buy puts unless you got to hedge something. So it's a little bit tough with this vol premium to want to bet on that right now. So to me, playing the short side is roughly off the table at the moment. Post JP Morgan position, maybe. So I don't love those trades. Some of the short premium trades are okay. I don't want to do those in size because, if you short vol here or something and you do get a big risk off move, which is totally viable, well, you could get, your hand slapped pretty bad. So, you start to look at what the softest spot is, and it's kind of like, hey, a 1 month rally is totally viable and very cheap to play. So I like that idea. Yeah. It's
a good, I think it's a positive shift. And by the way, great analysis last week, as you're telling us going into that expiry last week that downside was more likely than upside. Vol could continue to expand. So it sounds like we got some of that out of our system. It sounds like your view has shifted a little bit to some more kind of maybe neutral to even possibly bullish leaning plays, as long as you kind of maybe hedge it out by selling people who are betting on a big ramp with the out of the money calls in the S&P. But also, going into earnings too, we're going to get some single stock stuff too. Real quick, Brent.
Yeah, that's exactly right. And I think on that point, right, the big talk was how vol was expensive last week on a relative basis. And I say relative because even though the VIX was so high, there was a lot of vol premium because the market really wasn't moving that much. And my argument was, if we start to get a big realized move, we finally had that 2% breakdown, like watch out because like VIX is just going to go nuts, right? Vol's just going to go crazy, and that's where things get crashy. And we were, Trump's watching the stock market. It's almost like he knows, like, okay, I gotta say something now. Maybe it's not even real, but I gotta say something now at like the right possible moment just before the market opens to literally kick save that thing, right? It's like an Olympic goalie there.
Yeah, exactly.
Olympic goalie,
last minute, like that guy who finished the Winter Olympics going backwards on his skis. Thanks, Brent.
It works. So
whatever gets you across the finish line. Appreciate it. Great stuff. Thanks for the analysis. Great to get you back in the groove. Brent Kochuba, SpotGamma, short break. Mr. Pete Najarian standing by. We're going to talk a little gold, which is trying to find some life here. The Burl Ives trade, perhaps. Silver, gold. Talk some tech with Pete on deck for the gamble right after this.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back to the show. It's time for the gamble. We're going to look at some of the geopolitical stuff and how it might be moving the gold and the silver trade possibly back into the mix. Joining me, Pete Najarian, co-founder at Market Rebellion. Pete, what's going on, sir?
All is good, brother. All is good. You guys were great, man. I was listening to Brent, and one of the things that he mentioned today is something I actually did. Tesla.
Yeah. Okay.
He had talked about Tesla being one of those, what do you want to do kind of a thing. We had somebody out there, by the way, on the unusual options that we have. 20,000 of the April 470 calls were bought. So I would say that somebody's putting their stick in the sand right now. They're going to pile it in. So if we can get any kind of a run, that's going to be pretty great. So just so you know, all candid, I bought some myself when I saw that happen because I've been looking and waiting for something like that to happen with Tesla.
Sitting, waiting, wishing. Look, still held the uptrend, and by the way, Tesla does not get enough love for late last year making higher highs with an all-time record just under 500. The mags did too, but Tesla's came several weeks later. So it was really, really pushing all the way into the end of the year. And by the way, do you know what sounds pretty good with crude oil prices jacked up? Owning a Tesla.
Yeah, EVs, baby.
Yeah. I mean, I was talking about it with a couple guys this week, driving their cars around, and the price has gone up, and getting pinched. And this is where, obviously electricity prices can change, but not that much. And generally, they're pretty reliable. So, I was looking at the chart of Lucid as a potential kind of baselining, just because I think their cars are pretty sweet. But, I like the point that Brent was making, and you're following up on, which is the single stock stuff might be a nice way through to try and speculate on firming of this market at some point.
You know what? I'm sorry, I missed that because for some reason I had a misconnection there.
Oh, hey, there you go, Pete. You hear me? Back on?
Yes, sir.
There we go.
Yep.
I was just saying, I like the idea of single stock exposure as a way to try and play a firming of the market rather than trying to make this big S&P 500 bet. I do like that point.
No, I'm with you, and I want to look around. I want to see where are the stocks that people are still comfortable with, right? One of the things that really stands out for me right now is taking a look at the SMH. Take a look at that's still up 10%. That's a really nice move. You've got names like Taiwan Semiconductor, Applied Materials, KLAC, AMD, ASML, all those different names. And I think that there's a couple of names in there where we've been seeing some of the options starting to trade. And I say that all the time because there you are at the Cboe. I miss it, man. I miss standing there. I miss being right there, rubbing elbows with you. But, I look at names like Marvell, right? Marvell's been crushing it. Year to date, they're up 15%. They were up 6% already today. There's been buying coming in there left and right. So, you know what? When you've got 70
Marvell. Yeah, good eyes. I didn't even realize.
Yeah, it's done really well. Obviously, you guys have probably already covered it, but I'll just say the name.
We haven't.
Well, ARM Holdings, another one. It's up, year to date, 45%. It's up 20% today. Significantly, you're looking at performance gains in a name like that for all the right reasons, by the way. I look at some of these names and go, you know what? How are people missing these? And we have seen ARM unusual. We've seen Marvell multiple times now over the last couple of weeks. So it's been interesting. It's been really interesting. I don't know. We can go to the Burl Ives, man. I can tell you exactly what we're seeing there. That's crazy too.
Hey, you got good eyes on these ones. I didn't see Marvell. I didn't see ARM. I didn't. We had talked about some of the data center stuff that had been firming up, and we did talk SMH a little earlier. But I love these specific stock movers that are continuing the story, the main one, because they are reminders that come late April, when tech starts reporting, we're expecting pretty good numbers. A lot of these are going to be showing monster growth still, and ultimately the number one thing correlated with the direction of the S&P index, earnings, baby.
Yes, absolutely. And this has been going on probably for the last year and a half, 2 years even, where earnings season has been saving the markets under whatever circumstances we've got. And obviously, it wasn't that long ago we were watching the S&P go to record highs, right? The Dow was going to record high, NASDAQ going to. Well, how do they do that? Because even with all the negative things that are out there, and a lot of people focus only on the negative, when you look at these earnings and you see that there's still strength and they still look out with the guidance that looks very good in most cases, earnings season to me has been a spot where we're seeing absolutely something that is capturing the markets and helping lift them right back up again. So I'm pretty excited about the fact that we're not that far away from getting right back into the true earnings season. That's just weeks away at this point in time, which I'm really excited for.
It should be the baseline for figuring out if the market's going to be able to firm up. And it'll also tell us if we're going to break down, because if we start missing there, that's not good, obviously,
right.
Because some of the numbers in the economy that people aren't loving, the way we can explain through them right now is, hey, they might be AI-driven layoffs, they might be productivity-driven layoffs, they might be things that actually have some degree of positive attached to data, numerical negative. But then if the companies then don't start showing the growth we expect, then all right, that kind of caveat disappears. So we need the earnings to hit for sure. Okay, tell me about the Burl Ives, tell me silver, tell me gold. This one's tough for me, Pete. I don't know how to read it because they're holding on to support by just a a thin hair. And I feel like the volume or the volatility profile of these changed so dramatically over the last 6 months. How are you reading this right now?
Well, and as you know, this has been a great run for over a year. This has been a great run for both gold and silver, GLD and SLV. And it's really interesting. The timing of this is absolutely extraordinary, Oliver. Last week when you and I talked, we talked about the fact that, wow, we aren't seeing as much GLD. We're not seeing as much SLV. I'll give you a great example. If you go back to February, we had 10 hits in both. We had 10 hits in SLV, all positive. And the same thing with GLD, all positive. And boy, they were still working. Then all of a sudden you get into March and it dries up, which tells me that these guys, from a timing perspective, have absolutely just been unbelievable. And it's why, we want to pay attention to those that are doing so well.
You're seeing they hit those lows in Feb right after that first big, gigantic sell-off.
Yeah, and you look at March right now. So far in March, SLV, you know how many times it's hit? Twice. We're at March 25th. So basically, people kind of backed away, Oliver, and said, you know what? For right now, we don't need to do this. We've been so lucky and obviously good that they were fortunate enough to do really, really well. Buy goes up, buying going up, all that for a very long period of time. Now you get that sell-off, and suddenly these guys jumped out in March. I mean, the timing of that is absolutely extraordinary. So kudos to whoever this is that continues to buy in there. But, like I said, previous months, if you're averaging buying, and they're all buying calls for the most part, it's like 95% of what we see. It's been going on time and time again, both GLD and SLV. We're seeing that. So silver and gold, and that's what that Burl Ives trade is. But you know what? The fact that they stopped right there at the 1st of March and we've only had a couple of hits in both is just extraordinary. We'll see if that carries over into April. But it's good excuse to kind of take some profits and then take the rest off and then walk away for a little while until we start to see that consistency buying coming again.
That's an important change of the tone from the options flows that you're following. So maybe not quite as gung-ho as we were earlier in the first quarter of the year. Sounds like it's the main message, Pete. Maybe wait to see if some of that action starts up again. Great eyes both on the semiconductors and keeping us posted on the metals trade. Pete Najarian, co-founder at Mark Rebellion. Thanks, Pete. Have a great weekend.
Appreciate it.
Thanks a lot.
You too, man. Take care, Oliver.
You got it, sir. All right, when we come back, short break, and then it's time for the Cboe Exchange Traded Profile ahead of a bell ringing here in Chicago. I've got Howard Chan joining me from Kurv Investment Management. We're going to talk a little bit more on the metals side. We're going to talk some options-driven stuff as well. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection. seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick from Cboe. Tuesday, Wednesday, Thursday.
All right, we're coming out here in
into
10
the
seconds,
closing
guys.
bell, live from Chicago. All right, welcome back. It is time for the Cboe Exchange Traded Profile, and today we've got some fun stuff to talk about. We got 10 funds listed here at Cboe from Howard Chan's Kurv Investment Management. Howard, great to have you on the show. Thanks for joining.
Thank you. I'd love to be here.
Welcome to Chicago. Familiar, you guys have 10 ETFs listed here at Cboe, and the 10th one that launched in February was a copper income fund.
Yes.
Let's talk about that, because we were just talking metals, gold, silver. Does copper get enough love?
I don't think so. And I think for us, we tend to be long-term investors. And what we're seeing is, especially with what's happening now, is that this deglobalization trend continues. And as countries become more independent, they need to secure their own defenses as well as natural resources. So we think that over long periods of time, most of these commodities will become increasingly important that investors should have exposures in their portfolios.
For the copper exposure, tell me about how that fits in, because the gold and the silver trade have been fascinating.
Yeah.
As I was just kind of arguing, they've kind of taken on these new volatility profiles in a way, but from your perspective, which is piling on income on top of those, that's kind of ideal, right? Because then you've got more to work with, the more volatile they are.
That's right. And so all three are run very much in the same way. And so the premium that we're trying to harvest is exactly the volatility premium, and from there we can distribute income. And we pick these particularly because traditional commodity investing doesn't generate income. So if you're an advisor or a client who wants to construct an income portfolio, you're generally underweight these exposures because there is no income component. So these strategies are meant to give the exposures that you want, whether it's from reserve assets all the way to risk growth assets like copper, to give that exposure in your portfolio without sacrificing income.
When you're dealing with copper and metals, derivative products, what about exposure to the underlying, and how do you kind of manage that? What should people know about? Are they getting any exposure to the direct metals or anything they got to worry about on that front?
We are not invested in the underlying metals. So in the copper is actually copper and minor exposure. So what we want to do is actually typically investing in metals is actually, because it's not a security, it's not as tax advantaged. And what we want to do is actually leverage options to get a similar long exposure. So typically we would get a synthetic long exposure. So a long call short put will give you the same economic exposure as actually having exposure to the underlying.
Okay.
But in
basically
this
synthetic, you're basically doing a 1-to-1.
Exactly.
Okay.
And then, but because options are securities, it generates what we call good income under the IRS. And so it's a whole different way in which you can get commodity exposures. And the other thing is that you can get physical exposures. Those are typically taxed at collectible rates like gold and silver, which is much higher. And the other way to get exposure is maybe through futures. But as the market's been very volatile, demand and inventory has been shifting, you have these issues with contango and backwardation. So what we want to do is actually a new form of commodity investing, which is to get spot exposure without the things that you have to worry about with futures. And then at the same time, generate good income on exposures that don't typically give you income.
99 bips, under 1%, but I think kind of that 75-ish, 85, 90. I think what you're talking about justifies it, maybe a few bips higher than if you're just doing this with a basic stock, because there's some more complexities here. And you're also kind of providing a service, which is exposure to something that may not be a traditional, they may not have the right brokers, they may not have the infrastructure set up to go and buy copper if they want. So you are also providing that service too.
That's right. So we obviously have very strong margin management and derivative exposure risk management in our portfolio, but differently, we're still the active managers. So the long-term goal for these strategies is to outperform the underlying. And over time, hopefully if we deliver that, that would justify all the operations and expenses of the fund.
Okay. When you are talking with advisors about the kind of category of things you're providing, which also includes single stock exposures, the metals side, are they finding this as a new kind of crucial part of their approach? And do they take it from the risk side of the portfolio, or are they taking it from maybe the bond side? I guess when you're driving income, you could kind of argue for both.
Yeah, so I think one of the things that many have observed is that over the last 3 to 5 years, in a 60-40 portfolio, the reason why you have 60% stocks and 40% bond is that they're generally negatively correlated assets. But over the last 5 years, that correlation has actually get close to zero, so you don't get as much diversification. So for example, our gold strategy, people have been using as a replacement for bonds because it is highly negatively correlated with equities. But at the same time, some of our single name equity and other equity strategies, again, we look for this trade-off that advisors have to make. Typically, you have to make a trade-off between price appreciation and income. Growth stocks, they generally do not distribute dividends.
Right, they're too busy growing.
Exactly. And so they are usually underweighted if they're creating an income portfolio. So again, what we want to do is have better tools in the portfolio so that advisor can still create an income portfolio and have the exposures that they want without sacrificing the price appreciation.
Gold, your exposure, KGLD, the chart for gold we were just talking about is wild. That means you've got more to harvest in there. How much, I guess kind of when you launched this, did you think gold was going to behave the way it did? How has the volatility, kind of changed your expectations of how to run a product like this?
Yeah, and again, with most of our strategies, we go to our secular view, which is, as many people have heard about the debasement trade, people are allocating out of U.S. assets. They need something that retains value, and euro and renminbis are not really good substitutes, so the only thing that you can have is gold. So that was our long-term thesis, and typically vol for gold is, roughly, 1 or 2% standard deviations in a normal environment, and obviously in the last quarter, we've seen this skyrocket shape. That has helped the strategy because implied vol roughly 12-13% have increased to even let us generate better income in the strategy. It's fallen since then, and actually we prefer probably a more normal standard deviation expectations that, and we think this is a long-term story that is, even though we've had short-term falls, we think that this will be a long-term trend. People continue to allocate to gold. Yeah.
What kind of expiries are you using? How weeklies, monthlies?
Yeah. So we split it depending on the exposure. So for long-term exposure, so the 1-to-1 gold exposure, we typically do 3 months, and we use flex so that we don't have to roll as much.
Yep.
And then
hugely popular. Like a small portion, but a massive growth rate over the last couple of years because of funds like yours. Flex has just been blowing up.
That's right. And then the income generating option strategies on top of the long, we typically roll weekly. Depending on the bid-ask spread, some strategies like silver where bid-ask is a little bit wider, we roll every 2 weeks to save ourselves some transaction costs. But generally that has been pretty effective given that vol has gone up quite a bit in the recent environments.
Love the stuff on the metals. I want to make sure, though, we don't miss your single stock stuff. What utility is this? Just for a person who says, "Hey, I don't want to have to trade all the options myself, but I like this company, and I'd rather do this." Then what's the service you're providing, or what's the kind of market you're going for? Because do advisors use these, or is this mostly for a retail audience?
No, they're for both. And the two use cases are for advisors. Cover calls and other option strategies have been around since the 1980s.
Yep.
They generally are tremendously operationally intensive because they have to go in and look at a client's portfolio, which names, is there enough vol to actually premiums, and then if they don't have an execution desk, they have to do it themselves and then roll it, which is quite intensive. So one of the benefits is that we offer the service. We will do the rolls, we will manage the collateral, we will do the margin management. And more importantly, I think people forget is if you want to exit the strategy, you have to buy back and unwind all your trades.
Right.
And now
So
all you have to do is just
remove
sell
that
a shell.
liquidity, that liquidity constraint, right?
Correct. And then the other use case is really for folks. People are more and more dependent on the investment income they're generating. So the tech stocks tend to be higher vol relative to other sectors in S&P 500. So you're able to harvest that vol premium for those particular names.
Okay. And you got them in basically the mags. Great ticker for the Google one, by the way. Goop. Didn't get any hate from Gwyneth Paltrow on that one?
We're waiting for a call from her.
Waiting for a call from her. Okay, nice. Howard Chan, great stuff. Congrats on the 10 ETFs listed here at Cboe. Howard Chan, CEO at Kurv Investment Management. Great stuff.
Great.
Thanks
Great
a lot.
To be here. Thank
All
you.
right, we're going to take a short 2-minute break. I got Mr. Jay Soloff joining me. Great options mind as we go into the closing bell here. We got 12 minutes left. Stock market is trying to finish with a solid day here, but we lost a little bit. We're up about 50 bips right now. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago, Future of Finance. Let's talk some options. Let's go into the closing bell here with a bang. We got 9 minutes. I'm joined by Jay Soloff, lead options PM at Investors Alley. Good to see you again, Jay.
Thank you. Thanks for having me on again.
Last time we were together, we were hanging out in Vegas.
Vegas,
Yeah.
yes.
How'd it go?
It went well. Craps tables were, I was there for business, but just in case I might have played craps, I did pretty well.
Exactly. I mean, hey, that's what it is. You got to win in Rome. Though, I guess we were not in the Rome version of Vegas.
No, we were not. We were in the French side of it. But
Yeah, we were in Paris. All right, let's talk some options here. S&P slightly higher, 50 basis points. VIX just refusing to come down. Tell me what your first thought is on that subject, as it seems like the most important subject for a trader of options persuasion.
Yeah, it's been pretty fascinating, I think, watching what's been going on with SPX, volatility, and then realized volatility, and then the VIX, because they're all. I imagine the people who arbitrage that stuff are doing really well. I don't know. I'm too far removed from that to know for sure, but I would imagine they're doing well because you have some pretty big gaps there. You have, the VIX, which is a variant swap, so it includes the wings, which is staying pretty stubbornly high, and probably for good reasons. A lot of geopolitical risk out there, right? Mm-hmm. You have SPX, SPY. At the money volatility around 21, so it's not a direct apples to apples comparison. You have VIX 25, implied volatility about 21, suggesting that people are paying up probably for puts, but maybe also for out of the money calls,
right,
in case there's a rebound. But then you actually have realized volatility. It's sitting around, close to close is maybe like 14, and if you include intraday and overnight, maybe it's 17.
That's the part that stands out most to me, right?
It's an interesting kind of world out there, and obviously the bottom line is that people are still scared of a big sell-off, right? That's ultimately...
It does seem like, based on what we were talking about and sleuthing through the market today, there is a bit of a skew in favor of the downside puts. A few things kind of out of the money, people looking for some tails maybe to the right, but for the most part, looking for generally downside. But how many days can the market, not go anywhere before VIX collapses? Like, at what point do we kind of just normalize an elevated tension to some extent? Because my kind of to go back to Vegas, my kind of poker version of it is when you're trying to trade intraday geopolitical stuff, like, that's really high touch, high sensitivity, high chance of failure, oversensitivity. That's like poker, like I'm seeing every flop. I probably don't need to, and eventually I'm going to get myself in trouble.
Right. Yeah, that's a fantastic analogy. I think, though, what people are probably going to do if we stay in this pattern is that they might start selling, maybe getting rid of some of their holdings of the kind of the closer wings, and maybe just keeping some tail protection on, just something, just in case World War III, happens, something like that. So maybe they don't get rid of all the tail part, but they keep, maybe the 30 Delta type stuff. They finally say, this is too expensive. I'm going to start getting rid of this. I'm just going to keep on my whatever you want to call it, black swan protection, sort of thing. Because eventually, the bleed's going to be too much for people who are holding this. I mean, it's the high volatility, high time decay, right?
Yes.
So
it gets expensive to just sit there waiting for something to happen. In terms of trading opportunity, do you see anything then on the index level? We were talking earlier about single stocks versus index, maybe a little bit more opportunity on the single stock side, whereas a couple months ago that relationship was kind of flipped on its head.
Yeah. I mean, that's another interesting situation, because you still have underneath the surface the AI concerns, you have the private credit concerns, so there's a lot of idiosyncratic risk there. I've been personally having a lot of success with like the Mag 7 type stuff, trading the wings. Like, I know people will talk down on iron condors, but this has been a really good time to sell iron condors.
We've been talking them up. Patience the game, essentially, with the very range-bound market and volatility very high.
Yeah, particularly the wings. I mean, those things have just been paying off. And again, you got proper risk management, all that stuff. But it's been kind of a no-brainer trade lately. I feel like.
Okay, so no-brainer is kind of the range-bound iron condor type stuff. As we get into earnings season, you try and do it in some of the stock stuff. How do you, as an options trader, which gears towards math, try and put that stuff to the side, or do you feel like you have to have some kind of macro view in this environment?
I'm one that can't go into really any trade without some kind of macro view. Like
Okay.
I as much as I love indicators, like I need to have a reason behind everything, and sometimes there's no reason, and that's fine, and you can trade that, but that's never been me, right? I've always been, I need to have a macro case. I need, even if I make it up, right?
Sure.
I need to have some kind of thesis for why I'm doing it. So for me, it's a little more than just quantitative. There is a qualitative aspect to it. I think it's just good risk management,
Yeah, have some kind of framework. Have a framework ready to deploy.
Exactly. Exactly.
Crude oil, basically the important part of that framework. I
Yes.
mean, is that kind of where we're at, and how I guess what are you looking at in terms of understanding how that's factoring in right now?
Absolutely. I think when we see a sell-off in crude that's sustained, we'll see an increase in equity prices. I have been watching OVX, the oil volatility, that has remained really high, right? So I think we might see oil volatility go down a bit first before oil itself actually goes down. That might be a leading indicator, but that is something I've been watching.
That's an important point, and maybe answers for why the stock market's finding strength with crude only down $1.30.
Yeah.
Is that to a certain extent you just start to price things in, and now that we've been at $90, or let's call it under 100, for 1, 2, 3, 4, 5, 6, 7, 8, over a week now. That's volatility coming in.
Yeah.
Which, to your point, could just be the thing we need.
Yeah, it's either that, or people are just getting tired of buying volatility, right?
Yeah.
But yeah, I think so. I think hopefully this is heading towards its conclusion.
Yeah, me too. I hope so as well. Speaking of which, we got 2 minutes till the bell, but they are setting up and folks are rolling in. Jay Soloff, Investors Alley.
Thank you.
Nice, excellent close of the show.
Thank you very much.
Appreciate that very much. Thank you for tuning in to Chicago Future of Finance. I'm out of here and a little vacation, so you'll hear from me next week, but likely some calendar shifts. Thanks for tuning in this week. Good luck. Hopefully we'll close high. We're at 31 points and a half to give here in the next 120 seconds, roughly. See you later.